innovation strategy at Plug and Play. And before Plug and Play, I worked as a management consulting doing international projects in corporate strategy, M&A, fundraising in Singapore, Canada, as well as China. And before that, I worked in various other roles in PE, digital assets, accounting, and valuation. I'm currently a chartered alternative investment analyst as well as chartered investment manager. In today's agenda, we will go over two major topics. One will be briefly going over introduction on Plug and Play, as well as the open innovation space that we are currently working in, and some of the startup opportunities for the startups. And then we'll dive into an introduction on venture financing and some of the recommendations that I have for startups if you're starting out and looking to raise financing. And finally, due to the time limitation, most of the things we are going over here will be more of the principal concept. And if you are interested in raising money or in certain topics, I really recommend you to do more research and read more books. So let's get started. Whenever I do an introduction of Plug and Play, I always like to start with a story. And the story of Plug and Play really began in a tiny building on 165 University Avenue in Palo Alto, right beside Stanford. And our CEO and founder, Saeed Amidi, he was a traditional businessman doing business in industry like plastic packaging, bottling, and real estate. So things have been really steady and slow all the way until the 90s. And he was renting out real estate. And in the 90s, there's this new technology that came out called internet. And many students in Stanford decided to quit school and work on a startup in that space. And two young men came to our CEO and asked to rent the second floor as their office and start something called a search engine. And back then, nobody knows what a search engine is. So our CEO thought, as long as they pay the rent, let's rent it to them. And so the company grew from 2 to 40, and quickly they left the building. And before they left the building, they took a photo. And this is the photo. As you might have gathered from this photo that the company is called Google. And we certainly have missed out. And so our CEO saw Google going from nothing to, Google today. He started to wonder, what is he doing in the business plastic packaging and real estate? So he started to give a try at investing in the startup. And luckily, soon there's another startup that moved in that working on online payment. So he negotiated a deal with the startup that he will offer 1 year of rent for free in exchange for the equity. And this deal was really favorable for the startup at first, since they don't even know how much equity they are really worth. Their equity were worth, but a couple of years later, the startup was sold for $2 billion to eBay, and the company was called PayPal. So over the next few years, our CEO did more and more venturing in the investment in the venture space, and we were lucky to confront another few good companies. And finally, he have realized this is more profitable than real estate and plastic packaging, and perhaps it's time to go in for all in on this. So in 2006, he bought a building in Sunnyvale, California, from it's a former Philips Semiconductor R&D center. And he started doing what he did back in the small building, but on a much larger extent, inviting startups to come into the building, inviting VCs in there, and eventually build out a little ecosystem there, and what we used to call it the Silicon Valley in a box. And many great startups came out of the building, and we managed to have some great investment. And that's some of the investment that eventually ended up either being acquired or it's still raising large amount of capital today. And things were going pretty well all the way until 2008. There was a little financial crisis that some of you might remember. If you're 30, you probably remember what happened then. And if you're under 30, you might have heard from your parents or read it somewhere. And it was a pretty tough time for us as our liquidity was drying up and we were not able to have a lot of funding for operations. But we were lucky that some of the corporations at that time started to realize that they have limited capacity for internal innovation, and they really need to look outside for other ideas and talents to compete with the startup that was coming into the field. And one of the corporate executives came to Plug and Play and saw the vibrant ecosystem that was there. So we worked a deal that they would offer to pay part of our operating costs, and in exchange, we would introduce startup to them. And we started to replicating the same method to many other companies. And over time, we have been expanding this, what we now call open innovation ecosystem, to a much larger global scale. And we grew from 2 facilities in California to now over 35 locations worldwide. And I imagine there's probably an office pretty close to you where you're currently sitting. And today, we call ourselves an open innovation platform, and we run over 60 accelerator programs annually, and we work with over 400 corporations on connecting them to startups. We also invest in over 250 startups worldwide, and we work with 180 VCs on co-investments. We currently run about 18 different accelerator programs in 18 different industry verticals and working with the companies working with industry leaders in these fields. And this is a brief overview of our investment portfolio. We have seeded about 12 different unicorns. This one's slightly outdated, and our startups have raised over $20 billion in funding by now. And this is a brief overview of our corporate clients. We work with the largest company in most of the major industries. And as we have discussed the open innovation, some of you might not be familiar with the concept, so I just briefly go over a bit of the history and the concept. So in the past, there's really this paradigm where startup is really against the bigger corporations, and the bigger corporations are trying to kill the startups. It's really this really not friendly relationship. But this really changed over the past 20 years with the emergence of the concept of open innovation. And this concept was coined by Henry Chesbrough from Berkeley University. And this quote really sums it up, the core concept. But I think it's quite long, so I summarized it for you here, that essentially not all smart people work for you. And corporations have really realized that you really need to look outside for talents as well as the ideas and technologies. And as some started to work with startups, they realized there are plenty of great opportunities that they have by working with startups. For example, by working with startups in different fields, corporations were able to find benefits all around, ranging from product innovation to human capital attractions. And by implementing many of the cost-cutting technologies and cutting-edge technologies that they are working on, such as AI and big data, they can now save significant costs in terms of their operation and improve their supply chain stability. And so the paradigm has really shifted over the past 20 years from startup versus big companies to startup working with big companies. And as Plug and Play, we stand in the middle to facilitate this partnership. But this also provides an amazing opportunity if you're a startup that's currently looking at this, as now if you're a startup and you're willing to work with a bigger company, now you can leverage their large amount of capital, asset, as well as distribution network, and to grow your business at unprecedented rate. And one example that we like to use is that we introduced What's Reward to Mercedes-Benz, a big company, of course. And when we introduced to them, Mercedes was so impressed with What's Reward's technology that they actually implemented their technology in all of the Class A cars and invested in 10% of their equity. And so What's Rewards really went from a company that's really small to suddenly working with Mercedes, one of the leaders in the industry, and now have funding to grow much faster and bigger. And this is only been on positive since the past 20 years. As you can see, the trend has been continuing as more and more corporates are opening offices in Silicon Valley to specifically work with startups. And this is not only a trend in the United States, it's a trend across the world. As you can see, the number of corporate innovation offices open in Silicon Valley, that's to work with startups. And in fact, the highest number did not came from the United States, it came from Japan, followed by United States, France, Germany, and China. And the corporation are not only active in just working with startups on business front, they're also actively investing in startups. As you can see, the number of corporate venture activities have really increased over the past 3 years. And in fact, this year might even surpass the highest number back in 2018, as the data here was in June. And keep in mind, that was in the midst of the pandemic. And they have becoming an ever more important force in this field, as in the first quarter of 2020, about more than they were involved in more than half of the VC deals that has happened. So if you're a startup that you're planning on raising any capital, it's likely that you will have a corporate venture capital investor. So if you're a corporation that's watching and have not looked into this space, I really recommend you start. And if you're a startup, you should really take advantage of this unprecedented opportunity and grow your business with a corporate client, especially if you're a B2B startup. And at Plug and Play, we like to say that innovation should be open to anyone and anywhere. And feel free to reach out to us if you're looking to look into the open innovation industry and work with partners in this field. So now let's jump into the main topic of today, which is venture financing. So today we'll briefly go over a few different areas. We'll start with the venture financing present and history to look at what was venture financing in the past, how that has changed, and what does it look like currently. And then we'll discuss about whether you should raise venture financing, since venture financing is not for everyone. And then we will look at where to raise your venture financing. That really depends on your stage, as well as venture capital process, term sheet, and valuation. And finally, we'll leave you with some recommendations to look into. So starting with present and history. So thinking about starting a venture in the past. Let's say I'm starting a venture in the past, a convenience store, I call it Jensen's convenience store. What does that look like? Well, to start that company, initially, the financing likely have to come from either my own savings or family, friends, or some fool on the street, which is unlikely. And this is usually a pretty stable operation. The business likely have been in existence for, the business category likely have been in existence for a long time. And for a convenience store, initially it costs some money to build a store, maybe do some renovation. And then once the first store is open, I'll start to see some positive cash flow. And then I'll probably work slowly and then increase the revenue as more and more people realize my store is there. And finally, maybe my first store will be successful over a year or two. And then I can start looking at thinking about opening a second store. And maybe by year 3, my second store can be opened. And by then, my option of financing the store is still quite limited. I really have to look into my own saving or the profit that I made from the first store, or possibly some bank credit. But likely that's only going to be from my inventory, because there's not too many other tangible assets that I have there. So the process will be pretty slow. And I can continue to repeat this process with my third store, but likely also slow. So in order for me to build a large empire, I probably have to keep rolling, and maybe many years later, and I open enough stores. Maybe by then, even my kid will be in control of the store now. I finally have more option to work with perhaps now, because I have a large enough scale, some other investor in the later stage could look at it. For example, private equity firm, or possibly I can tap the bond market. But by then, we are already in a much later stage, and that's already perhaps even 2 decades later that I start to have these kind of access to capital. And if I'm successful enough, I might be able to IPO and have access to more. And the entire process for majority of the earlier process is probably likely very slow and very gruesome. And the reason is that in order to grow fast, you need capital. But the problem is, for majority of the history of capitalism, capital really came in form of credit, and banks have been the primary provider of the capital. And the issue is, when banks look at people trying to get credits, they look at usually 5 major areas, and what they call the 5 C's as a credit analysis framework. And so number one, they look at big collaterals. How much asset can you collateralize for the bank, so to protect their downside in case you're default? They look at your character, essentially your credit history. Well, as a startup or as a young person, you likely don't have a very strong credit history because you're just starting out. And then they look at your capacity, which essentially is debt to income ratio. But as you're starting out, your income is quite limited. So that really does not help you with getting a lot of capital. And then they look at condition, which is economic condition, probably one of the only less backworking factors there. And finally, capital, how much money you have invested into the business. But as a young person, you probably don't have a lot of capital to invest into the business. So overall, these 4 of the 5 factors are really backward looking. And so this is really an issue of venture capital in the past, as with these back-looking metrics, you really cannot obtain much capital through credits. And with limited access to capital, you really don't have a lot of money to invest at first. So it really limits your ability to do really ambitious projects. As well, your growth will likely be quite limited because you simply don't have that much capital to invest in your growth. For example, opening new stores that are hiring new employees. And so this has been an issue for, I think, hundreds of years in the past. And for the traditional ventures, it is relatively okay because your early investment is likely going to be small, and your cash flow inflection points is pretty fast, relatively speaking. And your growth will likely not going to be too fast. But as we entered the second half of the 20th century, a new type of company started emerging, the technology companies. And the issue is these technology companies have a lot of uncertainties and requires a large amount of early stage investments. But once the product is finished, and if they're good and they get to the market, they can grow at an amazing rate. But these are also very ambitious projects that not many people can afford to finance. Initially, these technology companies are only invested by wealthy families. Today, we probably call them family offices or super angels, such as the Rockefeller family of Standard Oil or Henry Phillips of Carnegie Steels. And these transactions were typically syndicated by merchant bankers. But the problem is the capital was usually not enough for super ambitious projects. And this changed in 1946 when George Dorius started the American Research Development Corporation, the first venture capital that raised capital from source other than wealthy family. And this really brought in a new era upon the venture capital industry as a whole. And some of the most established venture capital were founded in decades after that. Sutter Hell Ventures in 1962, Greylock in 1965, KBCB and Sequoia in 1972, and they seeded some of today's most iconic firms such as Apple, Google, NVIDIA, Amazon, and many others. And eventually in the 1980s and 90s, corporations started to get into the VC space along with other leaders of today, such as Benchmark. And in the 2000s, incubator and accelerators such as YC and Plug and Play was establishing their own fund to invest in early stage startup at massive scale. And international VC such as Qiming Ventures, Sequoia China, and Hale House Capital were established to provide VC capital to some of the world's fastest growing markets and seeding today's emerging market tech giants such as Tencent and JD.com. And then in the 2010s, we've seen another phenomenon of SoftBank Vision Fund, which is hard to categorize and think about given just the massive size with over $100 billion in AUM. and minimum investment of $100 million. And their largest investment in Uber was $7.6 billion. So really, the idea is at this point, you almost no longer need to raise any capital from the bank anymore, as you can get almost any amount of capital from venture capital investor from the very start of your business all the way till your IPO, and possibly you don't even need to do IPO with SoftBank funding you. And what really happened is over the past few decades, the primary form for venture financing really have shifted from banks and credits to venture capital investor and equity, which are much more forward-looking. And now a lot of ventures now have abundant access to capital, and they can finance extremely ambitious projects such as Uber, which I don't think they have made money in a single quarter for decades. And they're now able to achieve exponential growth simply because the amount of money that's now available for them. And so if you look back into the history of venture financing, there was almost never a better time to raise venture capital than today, or maybe with the sole exception of the year 2000 if you're in the United States. But the point is, if you want to raise venture capital, now is a really good time. So now let's jump into the next area, is essentially, should you raise venture capital or not? And so since venture capital, as we have discussed it previously, that they were created for this particular high growth profile startups. And if you're not in that particular growth profile, then it might not be exactly for you, as we'll discuss. And you can definitely consider other options as well. And so in this case, I personally like to categorize companies into two major categories. And these are, of course, not mutually exclusive. And I will go into the characteristic of each into startup and small businesses. And if you, as an end, feels like your business mostly fit into the small business category, then perhaps venture capital is not a great option. And there are many other good options out there for you. But if you fit into the startup category, then perhaps you should look into raising venture capital. So the first characteristic I think is quite important is essentially looking at your business model. If you're looking to open perhaps a convenience store, then maybe this is not for venture capital, as this has been a pretty proven model in this space. But if you're looking to start something that people has never seen before and that's not proven, or you're starting something, for example, a Facebook in China where there wasn't a Facebook before, then perhaps this could be something for venture capital. And the second aspect is really your market. If you're starting a convenience store, your market is likely your neighborhood and not too much beyond that. But if you want to raise venture funding, and if you're a startup that is looking to dominate an entire category, perhaps in an entire country or even category around the world, then your market is extremely large. And that's the time when you really have to think about looking at venture money to help you to reach that large market. Another one would be growth. As a small business or convenience store, your growth is likely going to be quite marginal. And that's the example I gave before, probably take you years to really grow to become a much larger company. But as for other business models, such as if you are to create Uber, then you want to dominate the market as fast as possible and really build a network effect. So your growth is likely going to be extremely fast, and you will require capital to do that. And the next part will be operations. As a small business, for example, convenience stores, well, your operation would be pretty standard once you have the store up. And maybe you have a new store open, you might need to get a new store manager, but relatively speaking, the operation is not very dynamic. It's pretty fixed. On the other hand, if your business is growing rapidly and you're starting out with 3-4 people, but then you suddenly have to hire a marketing team, a product team, and then maybe you have to tweak your team because it no longer fits your product, and your team's constantly changing, then this is an area where you can think about looking at venture capital to help, and you would really fit under the startup category. And finally would be your goal. If your goal is for your business to continue to grow slowly, steadily, and then you perhaps can pass on to the next generation or sell it towards 20 years later, then perhaps you're falling more under the small business category. But if you're looking to grow your business extremely fast and then perhaps sell in a few years or maybe IPO in a decade, then I think you fall more under the startup category. And certainly venture capital could be an option. But well, I'm speaking about all of these kind of categorizing whether you should raise or not raise venture capital, whether you're a startup or a small business. It is by no means that once you fall under one category, you should not do venture capital, or you should, of course, raise venture capital. And one good example would be, oh, sorry, I missed the capital requirement. It's essentially, I think, really being summarized by the earlier comments that really, if you're on the left category, you need a lot of capital. And whereas you are on the right, your capital requirement will likely be a lot lower. And some of the exceptions that I want to mention is that even for milk tea shop, you can raise venture capital funding, and you can look at Haiti. So essentially, by all means, they're a traditional milk tea shop. The only thing that's a bit more different would be they're very good at WeChat marketing. And so in 2012, the company is funded, but then they did really well and they raised a Series A in 2016, quickly a Series B, and a strategic round in 2019. And by 2020, earlier this year, they are already valued at $2.3 billion and potentially looking to get IPO. But if you look at their business, by all means, they probably fit more under the small business category, but they can definitely still raise venture capital. So if you're ambitious enough, even your milk tea shop can get IPO'd. Now, let's say you do fall under the startup category, or you're on the other side and you think venture capital is for me and I want to raise venture capital. Now, where do I raise them? And that is a very good question. As for venture capital, it really depends on which stage of the development you're in. And I personally like to divide them into 5 major stages, starting with ideas, and then experiment, development, expansion, and then you reach maturity and possibly IPO. In this presentation, I imagine that the majority of the listener are probably in the earlier stage, so we'll primarily focus on the earlier 3 stages. So starting with the idea stage. In this stage, you're probably looking at what traditionally calls the pre-seed funding. And in this funding round, you're probably looking at just setting up your company, doing some preliminary research, or if it's affordable, you want to maybe do a proof of concept for your product. And the funding in this stage really ranges quite wild, depending on the industry and the product you want to do. If you are a software developer, maybe you can even develop the whole thing yourself, and you just need to create a corporation and register the IP. That could only cost $1,000 or $2,000. But if you're in perhaps a deep tech startup, then the initial requirement might be much higher. So you really have to think about, perhaps reaching out to potentially even institutional investors in this round. But generally speaking, this round is extremely wide. Your runway could last from 1 month to 12 months. But let's say if you're a software developer, you're just sitting at home in your mom's house and you're just coding, then perhaps even $1,000 can get you a long way. Whereas if you need a lab and a lot of expensive equipment, perhaps even $200,000 can only last you a month or two. And so in this round, the primary investor that you're looking at would be number one would be founder, essentially yourself, your family and friends, and they like to call it unfools. So if someone really believes in you, even though they're not your friends or families, and university and governments and foundations. And so example investor would be certainly my favorite investor would certainly be my parents, because they do not look for a hurdle rate from me. They invest in me because they love me, and if I do well, then I do well. If I don't do well, they probably will not sue me in court over some issue. And another example investor would certainly be your government. Essentially, right now, entrepreneurship is a big focus of majority of the government around the world. And so most governments have some type of entrepreneurship program. For example, I'm currently in Canada right now, and in Canada, they do provide great entrepreneurship program that provide you funding. You can probably get almost $20,000 for free from the government. And another one would be the universities. And university really want entrepreneurs to come out of their university. So they definitely have a lot of programs available as well that you could check on. And you can probably get quite a bit of money for free as well. And I'm sure MCIT has great programs for entrepreneurs as well that you should look into. And now let's say once you finish your first stage, you now have a general idea, you did some market research, and then you kind of want to get your product off ground and start to do some experimentation, start really seeding the idea, then you really reach the next stage, what I call the experiment stage financing. And so this is, generally speaking, traditionally you would call it perhaps seed financing, or really around there. And so the idea of this stage would be you want to hire a team to start helping you, maybe with marketing, maybe with a little bit of business development, or hire one or two part-time engineer to help you work on the product. And ideally, you could potentially do a pilot project if you're in B2B space with a corporation, and reaching your customer at this stage to get a feeling of whether this could be a viable idea or not. And in this round, the range is also very high. And this could range from $25,000 to $7 million. And this has been constantly changing over the past years. In the United States, and especially the West Coast Silicon Valley, that's the seed round could go to $5, $8, $10 million. But in other regions, it's perhaps much smaller. And even in Silicon Valley, it has changed quite massively over the past 10 years. I think it grew quite several times from what it was back in 2010. And if you look at the data from the Crunchbase, generally speaking, it would be good to have a runway at this stage between 12 to 18 months. And the investor in this stage is a little more than previously, as you can look at angel investors, since now you have more product. And there are quite a few angel investment forums out there that are international, as well as your local angel investors groups that you can reach out to them to potentially raise funding. But of course, angel investors also differ widely, as you have some of the angel investors, they might have made money in traditional industry. They might not really know how to invest in startup, but others are perhaps more experienced, like super angels that might have already seeded 10, 20 startup, maybe having successful startup of their own. So that really ranges and the amount of money they're willing to invest to you. But it would be probably the best that you reach out to them and to learn more about it. And at this stage, university and government are still a good option. I know that Singapore government has great seed funding programs, as well as European Commission, and probably with a lot of other government as well. Don't overlook this. And a lot of time they're willing to match the funding of other investors that's investing in the startup. So you can also look to that as well. And at this stage, incubator and accelerator, this plug and play will start to get into the picture, and we can potentially look at investing in you as well, if you really fit our profile. And the next will be the seed funds. And so over the past few years, a lot of really reputable VC has really moved into this early stage funding area and started to look at what startup that is already emerging and really can start to invest in them before everyone else does. And so funding become quite available at that stage from the institutional investor as well. So certainly if you have a good idea, you can reach out to Sequoia and A16Z to ask them for fundings. And then last one would be crowdfunding platforms. So sometimes if you don't really want to give up too much equity early on, you think you have a great idea that can really hit off with a lot of people, then perhaps going on Kickstarter and trying to raise some money there could be a good idea as well. And the best part is you do not give up any of your equities, but also you do not get any of the connection or knowledge from your potential angel investors or institutional investor at this round. And before we jump into the next session, I just want to give you an idea of how wide the round in this range can be. And if you just look at in different geography, it was in the United States. If you are raising early stage venture in the Pacific area, then you can look at $15 million of valuation amount raised. But then if you move to the Midwest, the amount decreased significantly. So it really depends on the region that you are specifically in. So I would really recommend before you raise any round to go to Google and go to a different website to search up the specific round in your specific region and the investor in your region. And then before jumping into a discussion, because simply it's a variation just too big. And especially if you get into the emerging economies, then the round get much smaller. But also because the cost gets much lower. And so moving on to the next stage, what I call the development stage. So traditionally, this would be somewhere around the Series A round, really also depending on your geographic location. And so in this round, the goal would be essentially to reach a milestone, to optimize your product or hire additional talent, really expand your team. And really by this point, you might have reached your initial customers and you want to figure out whether you can expand to a wider audience and starting to expand to more people and reach more people. And in this round, the funding, as I mentioned before, starts get pretty wide as well, ranging from 2 million to 25 million, and probably to some extent even larger than that. Especially if you're in Silicon Valley, this round can go up to perhaps even 40, $50 million. And the runway expectation, if you look at data, should be similar to the previous round, would be somewhere around 18 to 21 months. And in this round, you're starting to see more of the bigger capital provider coming in and institutional investors. And it's harder for angel to get involved in this round. You might still have some of the super angels, such as perhaps Chris Sacca, to invest in you. He's a billionaire. So these kind of investor might able to see you at your Series A, but more so you're starting to look at corporate venture funds such as Google Ventures, Intel Capital, Qualcomm Ventures to start investing in you. And certainly it'll be good to start bringing in these investors if you want to work with them in the future, as they not only have the capital, but immense other resources to help you distribute your technology or help you to grow. But another thing is you also have to be cognizant is, for example, there are a lot of competitive corporate venture out there. So if you get venture funding from one of the competitors, then you might look at problem with probably never be able to work with the other one. And when you work with corporate ventures, sometimes they would ask for the right to have the first right to buy your company, which could be issue when you raise later on round or when you're looking into get acquired by other companies. And accelerators like Plug and Play will still be in the picture as we still invest up to Series A. So if you are looking at that round, you can still certainly talk to us. And of course, the major venture funds like A16Z and Sequoia, they're still very active in this particular stage. And once you reach the expansion mature stage, this really becomes a huge wild card because by then you're raising money to really expand your team and really just even for acquisition at this point and going international. So the funding in this section, perhaps around Series C and D, E, F really gets even more wild. It could be small as 5 million, and it could be large as 14 billion, which could count as one of the largest IPO on Earth. And that was a Series C raised by Ant Financial. So this gets even more wild as the range become even higher because a lot of corporations are already profitable at that point. And so, the runway may not even be a viable metrics at this point, but you could also be like Uber burning a lot of money. And at this stage, the universe of investor become much wider. You could look at plenty of investors because by now your company has a much lower risk comparing to the traditional startups. And much of the traditional investor can start investing. For example, on one side, you could look at family offices that does have direct venture capital arms. You could look at pension funds. You can look at sovereign wealth funds, private equities, hedge funds, and corporate venture funds are still pretty active. And then growth equity and just traditional venture funds. So really by now, your universe of investor has increased by a lot, and you now have a lot more options. So if you are in that stage, definitely be open-minded. Almost every single investor that's in the alternative investment space can potentially invest to you, and you should really explore your option by then at that point. But by then you also should have a good financial advisor or banker to really help you with this. And if you're interested in learning more or you want to raise venture financing, I would really suggest you to go to these 3 sites to look at what's out there, what's the data, what is the data in your particular geography, to really learn more about the specific information. So when you talk to venture investor, you can provide more insightful comments and really have a better idea of how much money you should be raising in each round. And finally, let's talk about venture financing process, term sheet, and valuation. And so, generally speaking, I divide the process to before term sheet and after term sheet, pre-term sheet and post-term sheet. So before term sheet, essentially, it's really first starting with you trying to sell to one of the venture's partner, or essentially a lot of time currently in the venture capital firms, they call themselves partner, they're usually analysts, and they call them general partner, they're the real partner in the venture firm. And so it first usually begins with you selling to one of the partner at a venture firm. And then once you convince them this is a good idea, then it becomes the venture partner trying to sell internally to their own firm. And then once they're all sold, then you move into the investment stage. So selling to venture firm will essentially usually start with initial meetings, such as a pitch event or some kind of networking, or you through an introduction. And then after that, you probably would do a follow-up and send some materials over to the person. And ideally, they start looking into you and doing some analysis. But in reality, a lot of venture investors are really busy, and you likely have to follow up with them however many times. I've seen some investors that invest almost right away start discussing term sheet and due diligence. Some I've seen after 6-8 months, and really depending on the timeline of the venture firm itself, as well as the life cycle of their fund. But generally speaking, once you follow up, they do the initial analysis, they will start thinking about doing due diligence on you if they really like you. And so you work with them on the due diligence process. And after that, they will draft investment memo and share it with the investment committee. And so essentially at this stage, they're trying to convince the other partners in the firm that they should invest in this. And if that gets passed, well, usually in that stage, there's a lot of question answering, and the partner will come back to you to ask these questions. And once the Q&A is done and everyone's happy, then you move to the investment stage. You negotiate the term sheet, and then you sign the term sheet. And so once the term sheet is signed, you reach the next stage, which is the post-term sheet, which will be essentially the legal process. And this process usually takes about 4 weeks, and you really shouldn't be worried too much about this process, since usually handled by the lawyer anyways. And usually it just involves different counsel dealing with the different due diligence requests in terms of finances and the other due diligence. And then you goes into trying to reply to different comments, dealing with parties having different issues. And then usually in 4 weeks period, these issues can all be resolved, and you could close your deal in a matter of a month. And so since in the venture process, probably the most important thing would be would be the term sheet. And it would be a good idea for us to briefly go over what term sheet entails, and what term sheet is, and some of the important factors that you should look on a term sheet. So in short, term sheet is essentially a marriage between you and your investor, and it outlines the condition regarding control and economics. And these two are the most important aspect in term sheet. And so term sheet is actually not legally binding, but it's a very important process that if any investor or startup that walk back on a term sheet without a very valid reason will certainly have its reputation damaged in the industry. And in this particular instance, we will discuss about term sheet regarding regular equity, but there are many other term sheet out there for convertible, safe, KISS. I recommend if you're looking into these kind of other instruments, you should really go online and do some additional research. And so let's talk first about the economic aspect of the term sheet and the key terms there. So in the economic aspect, really the most important thing would be valuation. And at that point, the idea for you is to maximize your pre and post money valuation. But you want to keep in mind that you do not want to do this at the expense of having other unfavorable conditions. You also don't want to set your bar too high that it's going to be hard for you to clear for next round. So you might have to have a down round discussion, and that is not a fun conversation to have with your investors. The second one would be option pool. That's essentially the equity reserve for future employees. The important thing here is to discuss whether to have the option pool post-closing or pre-closing. And if you do a pre-closing, then it's really you diluting yourself more and the investor don't dilute. If it's post-closing, then it's really investor getting diluted too. And this can come out to be quite big in the earlier stages. It could be as much as 8% impact on the economics. The next one would be liquidation preference. That's really one downside protection, and another is additional return for the investors. Really here, if you do a one-time non-participating liquidation preference, it's pretty standard and it's not too bad. And any more, you should really have a good discussion, and you should really do more research on that as well. The next one would be dividend. This is essentially additional return for the stockholders. Really here you will look at cumulative or non-cumulative, or whether it's declared by the board of directors. If you aim for non-cumulative and then declared by board, this part will probably never come into play in any of your future. Actually, you likely will never declare a dividend. And the last one will be anti-dilution. So this is essentially to protect your investor during the down round. And usually that goes with full ratchet or one type of weighted average. I would say as long as you're going for any type of weighted average anti-dilution clause, you should be fine. And going into controlled terms, I think three major ones would be certainly board control. So essentially how much representation investors can have on the board. And I would say earlier on, it's usually that I think you can probably have more control, but eventually investor as a class will surpass you, or at least with similar control. The good thing here is to have a good balance and perhaps have an independent board member that can do tie breaking. And for voting rights, this is essentially how much voting right each class of share gets. When you issue different instrument to investor, you can think about this: how much voting right do they get, and also whether how much voting right you have, because a lot of issue is not done by the board voting, but by shareholder as classes voting. And finally, investors' right. There are a lot of investors' rights that to be discussed. We do not have time here, so do go on and search. There's tag along, pro rata, and different control provisions for budget approval and things like that. So do a more detailed research on that if you're looking into raising venture. And then there's a good book to read called Venture Deals that I will show at the very end, that if you're serious about raising venture capital, you should read the book. And for valuation wise, let's talk about a few different considerations, as valuation is the perhaps most important part on your term sheet. So at Plug and Play, when we look at early stage startups, we primarily look at the 3 T's. So team, essentially, how good is the team? How much experiences they have? For example, if your team's all 3 from MIT then and have 10 years of experience, then I really have a strong confidence in you. But if the team, all 3 of them have never had any education experiences, no industry experiences, just fresh grad students, then maybe not so much confidence there, and the valuation certainly would be quite limited if they can raise any. And then you look at the technology aspect. So whether what kind of technology you have, how advanced is it? And sometimes you look at, we as a company, we don't invest in many deep tech, but if there are companies that invest in deep tech as well, and also how advanced your technology is. And finally, we look at tractions. For example, do you have any partnerships with corporations? Do you have any strategic partnership with distributors, or have you really sold some of the product already to customers? What have you done already, right? And then we combine these to get an idea of how much startup is worth and whether we want to invest in the startups. And that's the three most important factor, but there are also other major factors such as your business model. For example, network effect, your industry that you're in, right? Are you in the heavy asset industry? Are you in a light asset industry? In software industry, these all impact your valuation as well. The market size, right? Also, are you aiming for a small market? For example, if you are, let's say, in Singapore and you're focusing only on the Singapore market, then really the market size is quite limited. But if you're in the United States and focusing on quite a large category that potentially have tens of millions of users, then market size is very favorable. That will impact your valuation as well. And then competition is another big part. Are you starting a company in an industry that there's very limited competition, or is there a very established player that you're trying to get a pie off? And finally, the stage which you are in, of course, as we have talked about earlier, which stage of the financing journey are you on? Are you in really idea stage, or are you already at the experimenting or developing stage? And that impact your valuation massively. And in terms of valuation methods, there are four major types of valuation methods. You have the factor-based methods, so that would be Berkes scorecard risk factors, or the asset-based valuation methods. That would be book value, liquidation value, cost to rebuild, or relative value methods, such as you compare your company to a public company, the public comparable present transaction, and intrinsic valuation, such as discounted cash flow. And so factor-based is traditionally really used in early stage startup when you cannot really get a good idea of how much the startup worth. And I would say even using factor-based is still very, in terms of, I wouldn't say exactly objective in terms of valuing startups. And then you have the asset-based one that would be more for the tangible asset. If your company is a real estate company, then maybe there's more there. Or if you are really liquidating your company, you're going through in the United States, it would be a Chapter 7 bankruptcy. You're trying to see how much the company is left. But generally speaking, for startups, this is a not very often used type of valuation method. And finally, relative valuation and intrinsic valuation. These are often used together in venture capital to determine the valuation of the firm. As well as also used pretty often in much later stage companies for merger and acquisition, as well as for investment looking to invest into companies. So factor-based, for example, Berkes method, which is quite simple. Essentially, this was invented by Dave Berkes back in the 90s, and he come up with these few different factors, and then you just assign a value to each one, add them up, and then you have a valuation right there. And for asset-based one, a simplified look will essentially just look at how much net asset you have. So you would, or book value you have, it would be your total asset minus your total liability, and plus or minus the write down and write up on your book value of asset. And then you come down to your book value, essentially how much your company is worth. Again, not used very often in the venture scenario. Relative valuation examples, for example, present transaction, that's somewhat used more, is essentially you're looking at here would be 3 of the previous transaction of similar companies perhaps. And then you look at how many times of sales they were sold at. For example, over here you would have over the past 3 transactions of similar company and similar size, they were all sold at 1.9 times of their revenue. And so if my company is worth $23 million, I can use that times by 1.9. So my company really is worth $43.7 million. And then going to the next section, essentially would be the intrinsic value. So really, this is saying that the money today is worth more than money tomorrow. And then what you do is, especially for startup where you don't really have a lot of revenue right now, but perhaps in 5-10 years you can grow massively. So the idea is you started for forecast out your your cash flow in much into the future until your operation become more stable. And then you assume that you sell your company at that particular point, and you essentially discount the cash flow using certain rates. That could be a discount rate, um, um, or you could be what they call the WACC rate, or it could be your hurdle rate for the particular venture capital. And then once you discount every year's cash flow back to the present, and then you have a today's present value. And sometimes in venture capital, they use what they call the venture capital method, which is a combine of the previous relative valuation, and DCF is essentially thinking about maybe the venture capital can exit maybe in year 8, and then they sold the company in year 8, and then you discount it back using their hurdle rate to today's value. So this DCF and intrinsic valuation is a quite complicated subject relating to several series like capital asset pricing model and various others. So if you are interested, I recommend you to read a book on this, as our time is quite limited today to go over this. And finally, some recommendation for the startup, and that is our last section. So number one, I would say definitely do your research. And this is really, I think everyone will say that, but I cannot, like, there's just been so many times that I've seen startup wasting their time not doing research and talking to the wrong VC, maybe that don't even invest in their geography, or starting a business that already has a multi-billion-dollar competitor. So really, don't waste time on these. Just do your research, and you'll save a lot of time. And the second one will be talking to people more. And so tell people about your ideas. Don't hold back. You never know which one of your friend or your parents might have good connections that can help you. So be open, talk to people. And the third one is really just be positive. If you're going through this process, you are going to get a lot of rejections, a lot of challenges. And really, it's important to keep positive and just keep the grind going. As one of the startup I recently worked with in April, they were trying to raise a round. They were running out of money, and nobody would invest in them even at $2 million valuation. And last week, they were already raising at $15 million, and they were talking to Lightspeed Ventures. So really hold on and be positive, and good things might happen. And the fourth would be take free money. A lot of startups don't take free money. There are plenty of government money that's free for you to take, and even potentially you can apply to programs in different university, in the government, even different government programs in different provinces or in different states. So really do take that. I have heard of Canadian startup that really, before it even got started, it took $20,000 of government money. You essentially don't need to raise your pre-seed money. And the best thing is government money is free, no equity required. And the last one would be, please don't always aim for a high valuation, as I mentioned before. There's too many times I've seen startup getting burned by asking too much of valuation in the earlier stage. You might think you will never have a down round, but you never know. It might just happen. And it happens a lot of times. So really, really think about your valuation. Don't be too ambitious, and don't let your ego put you on the wrong path. And so that's it from me. And I would say, if you are interested in venture financing, do buy this book and read it. This is essentially one of the Bible for venture capitalists. Once you read it, you'll have a really good understanding of the field. And thank you very much. So I'm not sure, I think right now, if you have any questions, feel free to ask. So I don't see any questions. Then if you are a little bit shy and you don't want to ask here, feel free to shoot me an email, and I would be happy to respond to you there as well. So I see a question that from Mason. If you have an idea for startup, what would be the first step to evaluate your idea? So I think number one would be think about what is out there, right? And I think a lot of time when we think about a good idea, for example, in our life, we would say, hey, this could be a good idea, and then we just thinking about starting a startup, but you really should look into it, see if someone else has did it. And a lot of time you'll find is number one, there is an established company out there you just haven't seen before. And the second is someone did it and it failed. So you should really figure out whether you have a competitor in the market or whether someone did it or failed, or think about why this idea was never started. And so once you have a good idea about that, then you can start to think about starting an idea. So definitely this, I would say, would be the first step to evaluate your idea. And also you can talk to your friends and family, so it's not only you thinking about it. And the second question I see is, how do you see the venture market in the Middle East? So I think certainly Middle East have its potential to be the ground for a lot of venture capital activities. As you know, that Middle East is already has a lot of capital available. Although I would say a lot of these capital traditionally have been deployed into the natural resources and more traditional sector. But I know that currently, for example, country like Saudi Arabia is really keen on building out the entrepreneurship environment there, as well as really in terms of diversifying the economy to a larger extent. So I think with a lot of government support, the VC space will definitely have the potential to grow tremendously. As you can take a look in China, where they did a lot of state-sponsored push for venture capital and startups there, and you can certainly see a lot of amazing companies and amazing venture capitalists coming out of there. And I think this could be the similar case for the Middle East as well. So I think that's all the questions. I'm seeing more questions in the Q&A. I actually did not see that. So will this be uploaded to YouTube? I think that's a question I think our friend from MCIT can answer. Is 20% equity fine for startup? If has not started up yet and only in development? I think really depending on what do you mean by 20% equity. If you're thinking about working for a startup and getting for 20% equity, that is essentially a founder's share of equity. So it's very good. Or if you are looking to invest in a startup and acquiring 20% of the equity, I think that really depending on the price and the company. So it'll be hard for me to answer here. The question from Nikki, what made you choose working VC over other areas of financing, and what should others think about when considering joining this industry? So I think really, to me, I really enjoy the entrepreneurial environment, where in the VC space get to meet a lot of people. And then my plan is that one day I will start my own company as well. And so I think it's a great place to accumulate experience and meet people. Question from Mason, what is the main challenge for startups after the COVID-19? So it's actually very interesting that a lot of startups we know actually are doing better with the COVID-19, as what we have realized is if you have seen the US stock market, probably seen that a lot of these ventures and especially technology startups has recently gone IPO, and their valuation have been amazing. Meanwhile, you're seeing other asset classes having much lower yield. And so overall, a risk asset is increasing in valuation quite a bit over the past couple months. So this really has also boomed on the VC side as well, as you see VC activities actually increased to probably more than before. And this year we could see more VC activities than even 2019. So overall, I would say that in terms of venture financing wise, COVID-19 has been even good for the startup, as startup benefiting from this increase in capital participation, as well as they are mostly in more of the emerging digitalized space that is not as impacted by COVID-19. But other issues, if you are a startup selling to the traditional industry, such as automotive and industrial, it's a lot harder. It's a lot harder task, as a lot of them are facing budgetary cuts. So in that space, startups are facing a lot of issues that maybe this year they will have limited sales to these companies, and they certainly have to figure out a way going forward, as if the situation does not improve with COVID-19, we will likely to see continued challenges working with the industrial companies. And another question here, how to find a team? So I think certainly working with, there's plenty of ways to finding a team. One could be that with your friends and people you know the most, which could be a good, easy start. But of course, a lot of time, let's say if you are in business or if you are in finance, most of the people you're around with perhaps have similar skill set, which would not exactly the best fit, and you want to look for tech talent. So perhaps you can go to different events. For example, we run a lot of large open events every year with a lot of aspiring entrepreneurs there. A lot of other companies run these kind of meetups for startups and founders. And you should attend these kind of meetings to meet people with similar interests with you. And then you could have team members from there with different skill sets work with you. But there are really plenty of ways to do that, as well as a website like AngelList. You can find people looking for founders. You can apply there or put your own posts up. I think that's it for the question here. I want to thank everyone for participating in this session, and I want to thank our friends at MCIT for hosting this and for the invitation. Thank you very much.